Internal Revenue Service IRS tax news. IRS begins correcting tax returns for unemployment compensation income exclusion periodic payments to be made May through summer. IR 2021-111, May 14th, 2021, Washington. The Internal Revenue Service will begin issuing refunds. There's a link to that refunds here this week to eligible taxpayer who paid taxes on 2020 unemployment compensation that the recently enacted American Rescue Plan later excluded from taxable income. So here's what we have with the unemployment. This is a quick recap of it. Usually unemployment compensation is taxable. So usually you would get some form of 1099, typically from the state who paid you the unemployment compensation. You'd have to include it on your tax return as income. Something on income on the tax return is usually bad because everything's reversed for taxes. So income is bad because if you have income, that means the IRS wants their portion of it. So that's the general rule. But this time they had an exclusion. They made an exclusion for the amount of income to be included, which is good because then you could get the unemployment possibly and not have to include it in income and therefore possibly not being paying taxes on it. However, this rule was enacted late, and so people may have already filed their 2020 tax return before they were aware of the rule, or even if aware, it's kind of a new thing, so maybe they didn't pick that up and maybe they filed their taxes having recognized the income as taxable and overpaid their taxes in that case. So in that case, then your first thought might be, well, now I need to file an amended return. But you don't typically need to file an amended return. And in fact, the IRS has been trying not to get people to file an amended return because I'm assuming they're overworked on work and they would. So what they're going to try to do is fix it on their end. So if you already filed and you included unemployment compensation as income, and then they said you don't have to do that for at least a portion of it, and then you need to change it, they're going to change it automatically in most cases. And in most cases, you don't need to then adjust the return, and you should start getting the payment for the difference if you have overpaid. So that's where we are at this point, my quick recap on it. So the IRS identified over 10 million taxpayers who filed their tax return prior to the American Rescue Plan of 2021 becoming law in March and reviewing those tax returns to determine the correct taxable amount of unemployment compensation and tax. This could result in a refund, a reduction balance due, or a change to tax, no refund due or amount owed. So you would think that if you had something included in income and then they removed it, that you would think that would lower, in most cases, the amount of tax that would be owed if you owed tax, or the amount, or it would increase the amount of refund because you would think it would be a beneficial thing. But in some circumstances, maybe your income is below a certain threshold and maybe it doesn't have an impact on the tax, in which case it wouldn't have an impact. But usually it would be a beneficial thing. So these corrections are being made automatically in a phased approach, easing the burden on taxpayers. The first phase is underway and includes simplest returns. So they're going to start at the easy ones. I think they do this, by the way, to start at the easy ones to try to, let everybody know they're taking action, right? So they can get to the ones, the low-hanging fruit, and let everybody know, hey, look what we've done. We're making progress here. And then they get into the more complex stuff. It seems to be kind of the approach oftentimes. So the next phase will include the more complex tax returns, which the IRS anticipates will take through the end of summer to review and correct. So it could take through the end of summer here. The first phase of adjustments is being made for single taxpayers who had the simplest tax returns, such as those filed by taxpayers who did not claim children or any refundable tax credits. So that makes it really easy if you're talking about a single person and they don't have any tax credits and no dependents, no children, because if you adjust the income level, the problem with adjusting the income level with regards to taking away the unemployment, which adjusts the income level, that could have an impact on different phase-out type of calculations and different credit calculations, especially ones that can be more complex in any case. So it's easier to do the tax returns without that. It does look like they're going to go into those more complex tax returns and try to take care of those types of situations, like the AGI, the adjusted gross income changes, and then you could have some adjustments to credits and other kind of deduction phase outs due to that. So in any case, the IRS will issue refunds resulting from this effort by direct deposit for taxpayers who provided bank account information on their 2020 tax return. If valid bank account information is not available, the refund will be mailed as a paper check to the address on record. The IRS will continue to send refunds until all identified tax returns have been received, reviewed, and adjusted. These refunds are subject to normal offset rules, such as past due federal tax, state income tax, state unemployment compensation debts, child support, special support, or certain federal non-tax debts, i.e. student loans. The IRS will send a separate notice to the taxpayer if the refund is all set to pay unpaid debts. So in other words, this is kind of like the normal process, whereas if you get a refund, then and you owe the IRS taxes on some other some other thing, especially the IRS, the most obvious thing would be, well, if you got a refund in 2021 or they adjusted your taxes and you were to get a bigger refund or something like that, and you owe taxes on the prior year, then they're going to keep your refund and apply it to the taxes you owe them on the prior year. Now, not only that, but they've kind of expanded. It used to be that the Fed and the state were kind of different. They didn't really talk to each other much, and they still don't for the most part. You don't want to try to send your state tax return to the IRS or something. That won't turn out too well. But they do talk to the degree that if you get a refund on the Fed side and you owe the state, it's quite possible that they keep your refund and pay it to the state. And they also somehow pick up the child support. I'm not sure exactly how they know about the child support, but they have the information for the taxes on both sides related to the child support. But in any case, if they know child support and you owe child support, then they might pay that out if you were to get a refund, and so on. So if they take your money and pay it to somebody else that you owe money to, or themselves for some other debt that they owe, they'll send you a letter and let you know that they did that. So the IRS will send taxpayers a notice explaining the corrections, which they should expect within 30 days of when the correction is made. Taxpayers should keep any notices they receive for their records. So obviously, if they change your taxes, you want to make sure that you have a record of it. And then when you do your tax preparation for the following year, when you roll over the information for the current year to the following year, oftentimes for lower income individuals, it might not have any impact if you roll it over. You could just basically do your taxes and fresh. But if there's any kind of rollover information that you're going to need from the prior software, and you need the prior adjusted gross income, or you're making estimates based on that calculation, then you want to make sure that you adjust it so that you have that adjustment made when you do your taxes next year. So taxpayers should review their return after receiving the IRS notices. You may want to check it on your side as well. If you have tax software, and many people did their taxes possibly with free tax software, if their income level was below a certain threshold, you probably don't want to file a 1040X, but you might want to then do the adjustment on your end in the tax software, see what the change would be, just to verify that the IRS gets it right. They should, when they send you the difference, they should get it right. And if you do have a more complex return, then you want to make sure that they're picking it up correctly. So, for example, if you didn't have an earned income tax credit last time, when you had the income of the unemployment, and then for whatever reason, like now you have access to the earned income tax credit or something like that, then you want to make sure that you're double checking it to see if the IRS is picking up everything that it should pick up when they adjust the income due to the unemployment compensation. So the correction to any earned income tax credit, the EITC, without qualifying children, and the recovery rebate credit are being made automatically as part of the process. So the earned income tax credit is based on, in part, earned income. It's one of the more complex types of credits there are, so any kind of adjustment to the income level can have an impact on this calculation. They're saying that for the most part, they will be able to pick that up and make the adjustment for it. However, some taxpayers may be eligible for certain income-based tax credits not claimed on their original return, such as the Earned Income Tax Credit, EITC, for their qualifying children. So if so, they should file an amended return if the revised adjusted gross income makes them eligible for additional benefits. So in other words, if you already had the Earned Income Tax Credit basically on the books when you did it last time, then the IRS should be able to make the adjustment to the income, and it should adjust the earned income tax properly. But if you had some kind of benefit or adjustment that just wasn't there at all, it's not that it's going to be adjusted, it wasn't there at all due to the income level difference, and now you do have access to that benefit, then the IRS might not pick that up. And in that case, you might have to do an amended return at Form 1040X. So normally you don't have to do a 1040X for the most part, but in a special case like that, you might have to. So again, I would do the calculation on your tax software, not necessarily filing the 1040X, but just looking at the calculation to be prepared to do the 1040X if you have to, and then just double check and make sure that the IRS gives you the difference that you would expect given that calculation. So more complex corrections will begin upon the completion of the first phase and involves couples filing as married filing jointly. Unemployment compensation is taxable income. The American Rescue Plan includes $10,200 in 2020 unemployment compensation from income. So it excludes. So the American Rescue Plan excludes $10,200 in 2020 unemployment compensation from the income used to calculate the amount of taxes owed. The $10,200 per person exclusion applies to taxpayers, single or married filing jointly with modified adjusted gross income of less than $150,000. The $10,200 is the amount of income exclusion, not the amount of the refund. Refund's amount will vary, and not all adjusts will result in a refund. So in other words, when you're talking about the $10,200 not being included in income, that doesn't mean you're going to get to $10,200. That means that it's not included in income, so you shouldn't be paying taxes on it. It's going to lower your taxable income, so it will depend on your tax rate as far as how much it'll lower the actual taxable income, as well as any other kind of credits that you might have that would be impacted by it. So you would think it would be substantially lower than if you remove the $10,200, your benefit you would think would be substantially lower than that, because again, it's just lowering the income and it's based on your tax bracket and other kind of credits and calculations. So the legislation also suspends the requirement to repay excess advance payments of the premium tax credit, the excess APCT, if a taxpayer paid an excess APTC repayment amount when they filed their 2020 return. The IRS is also refunding this amount automatically. So this one's a little bit more confusing to understand, but hopefully they're going to pick it up automatically. And this is the one where if you're in the health insurance marketplace, then normally what happens is they try to anticipate what your tax credit will be, which I believe is called the PTC, the premium tax credit, and they call that anticipated amount the APTC, the anticipated premium tax credit. And so they're estimating what the tax credit will be, but they don't know what it is until you file the tax return. And then at the end of the year, normally you would have to match up what you got in benefits from the APTC, the prepayment, in the form of them lowering your insurance amount. So you basically got the money, but not in dollars. They lowered your expense of insurance by that amount compared to the actual credit. And if the amount of the APTC, the anticipated amount, the prepayment, was greater than the amount for the actual credit, the PTC, then you would think that you'd have to pay that back in some way. That would be kind of like the normal process, because that would mean that you overtook the prepayment. But it looks like they're actually waiving that. My interpretation here, do your own research on this, but my interpretation is that they've basically waived that. So then even if you overtook the APTC and it was higher than what you actually should have took compared to your PTC, that they might waive that excess amount of having to have an impact to basically kind of pay back the excess. That's my general interpretation of it. And it looks like they're going to calculate that automatically and send out the refund on that, so you shouldn't have to do an adjusted return for it. Similar kind of situation as with the unemployment. That does lead people to think that they're kind of incentivizing. In my mind, that seems like, well, that kind of incentivizes you to go to your insurance marketplace provider and basically misdirect about the level of your income to imagine it be lower, so that you increase your amount of premium reduction in the hopes that they do this again next time, right? Because that would lead people to possibly want to do something that would not be entirely accurate with regards to their estimate of what their taxes will be, in order to get a bigger prepayment up front, which you hope is going to be removed at the end of the year. Now, they say that they're not going to do that. They're telling us that this is a one-time thing. They're not going to do it again. But there's a lot of one-time things that, don't tend to be one-time things sometimes. So it seems like kind of a weird incentive to me. I'm not saying you should do that. I'm not saying you should go to your health provider and try to maximize your premium benefit just in case they waive the excess again. But, I'm thinking that's what some people might do. So in any case, so if the IRS corrects the taxpayer's account to reflect the unemployment income exclusion, the excess APTC amount that the taxpayer paid will be included in that adjustment. The IRS is also adjusting accounts for those who repaid excess APTC but did not report unemployment compensation on their 2020 tax return. Taxpayers who have not yet filed a tax return should follow the guidance for the Forms 1040 and Form 1040-SR. There's a link to those here, which details how to exclude unemployment compensation. For more information, we have some links below. Tax treatment of unemployment compensation exclusion for FAQs, frequently asked questions, and the tax year 2020 requirement to repay excess advance payments of the premium tax credit is suspended. There's links to that reading information here. There'll be a link to this in the description.